In the autumn of 2008, the global financial architecture fractured, forcing central banks into uncharted territory to prevent a total systemic collapse. The Federal Reserve deployed a monetary weapon previously relegated to academic theory, known as quantitative easing. By purchasing massive quantities of government bonds and mortgage-backed securities, policymakers injected trillions of dollars directly into the financial system. This was not merely a rescue operation for failing institutions. It was a fundamental rewiring of market mechanics designed to aggressively suppress long-term interest rates and force capital out of safe havens into riskier assets. The immediate goal was survival, but the mechanics of this intervention fundamentally altered the pricing of risk across every major asset class. When a central bank steps in as the buyer of last resort, it creates an artificial scarcity of safe-yielding bonds. Institutional investors, suddenly starved for yield, are pushed further out on the risk spectrum. This massive wave of liquidity acts as a rising tide, lifting the valuations of equities, corporate debt, and real estate simultaneously. The traditional relationship between economic fundamentals and market performance began to decouple under the sheer weight of this newly printed capital. At its core, this unprecedented liquidity injection functioned as a form of macroeconomic leverage. By artificially lowering the cost of borrowing to near zero, the central bank effectively subsidized debt expansion across the entire economy. Corporations seized the opportunity to issue cheap bonds, using the proceeds not for organic growth or capital expenditure, but for massive share buyback programs. This financial engineering amplified earnings per share, driving stock prices higher even in environments of sluggish revenue growth. The system became highly levered to the continuation of zero interest rate policy, making asset prices acutely sensitive to any hint of monetary tightening. This environment birthed the acronym TINA, standing for There is No Alternative, a concept that dictated institutional investment strategy for over a decade. With sovereign bond yields suppressed below the rate of inflation, holding cash or fixed income guaranteed a loss of purchasing power. Capital was practically forced into the equity markets. Consequently, valuation multiples expanded far beyond historical norms. Companies with unproven business models but high future growth projections saw their market capitalizations explode as investors heavily discounted future cash flows using near-zero interest rates. The resulting surge in asset prices created a profound and widening chasm in wealth distribution. Because the top 10% of households own the vast majority of financial assets, the benefits of quantitative easing were heavily skewed toward those who were already wealthy. The policy essentially hypercharged the net worth of the investor class through the inflation of stock and bond portfolios. Meanwhile, households relying primarily on wages for their income saw little direct benefit from the central bank balance sheet expansion, as the newly created money largely remained trapped within the financial sector. While asset owners watched their net worth compound at historically unprecedented rates, labor markets experienced a very different reality. Wage growth remained relatively stagnant throughout the 2010s, failing to keep pace with the rapidly inflating costs of housing, healthcare, and education. This divergence created a structural economic imbalance. The purchasing power of the average worker eroded in relative terms, while the capital class accumulated vast fortunes simply by holding on to their existing portfolios. The monetary transmission mechanism, highly efficient at inflating financial assets, proved remarkably inefficient at stimulating broad-based wage inflation. This fragile equilibrium was violently disrupted by the arrival of the COVID-19 pandemic in early 2020. As global economies abruptly shut down, financial markets plummeted, threatening a liquidity crisis that dwarfed the 2008 financial crisis in its speed and severity. The Federal Reserve responded with a monetary shock and awe campaign, executing years of asset purchases in a matter of months. They expanded their mandate, buying not just government debt but corporate bonds and exchange-traded funds, effectively backstopping the entire credit market and signaling an era of unlimited quantitative easing. The scale of this 2020 intervention triggered an asset price melt-up of historic proportions. Trillions of dollars in fresh liquidity, combined with massive fiscal stimulus checks deposited directly into consumer bank accounts, created a speculative frenzy. Retail investors, armed with zero-commission trading apps and excess capital, flooded into the stock market. Cryptocurrencies, meme stocks, and non-profitable technology companies experienced parabolic price increases. The market ceased to function as a forward-looking discounting mechanism for corporate earnings and instead became a pure barometer of central bank liquidity flows. Nowhere was the amplifying power of cheap debt more evident than in the real estate sector. As mortgage rates plummeted to historic lows, the cost of financing a home purchase dropped precipitously. This dramatic reduction in borrowing costs allowed buyers to leverage their capital further, bidding up home prices across the country. Existing homeowners capitalized on this dynamic by refinancing their mortgages, extracting trillions of dollars in home equity to fund renovations, consumer spending, or further investments. The operational leverage of real estate, combined with artificially cheap financial leverage, created immense wealth for property owners. Yet this housing boom exacted a severe toll on those outside the property market. As home prices skyrocketed, the barrier to entry for first-time buyers became nearly insurmountable. The down payment required to secure a mortgage grew at a pace that far outstripped the savings capacity of the average renter. This dynamic effectively locked an entire generation out of the primary engine of middle-class wealth creation in the United States. The dream of homeownership receded, replaced by the reality of rapidly rising rents, further squeezing the disposable income of those without assets. Economists quickly labeled this phenomenon the K-shaped recovery. The upper arm of the K represented the trajectory of the asset-owning class, whose wealth surged to record highs on the back of soaring equity and real estate markets. The lower arm represented wage earners and small business owners in service industries, who faced severe economic hardship, job losses, and dwindling savings. The monetary policies designed to save the economy from a pandemic-induced depression simultaneously engineered one of the largest upward transfers of wealth in modern history, exacerbating existing societal inequalities. The assumption that central banks could endlessly print money without triggering consumer price inflation was ultimately proven false. By late 2021, the massive expansion of the money supply, colliding with pandemic-induced supply chain bottlenecks, ignited an inflationary firestorm. The cost of essential goods, energy, and food began to rise at rates not seen in 40 years. Policymakers initially dismissed this as a transitory phenomenon, but the inflation proved sticky and deeply embedded in the broader economy, forcing a painful and abrupt reckoning for both the central bank and the financial markets. Forced to abandon their accommodative stance, the Federal Reserve initiated a brutal cycle of interest rate hikes, simultaneously shrinking their massive balance sheet in a process known as quantitative tightening. This pivot marked the definitive end of the free money era. The cost of capital, artificially suppressed for over a decade, violently repriced higher. This sudden tightening of financial conditions sent shockwaves through the global economy, directly attacking the very mechanism that had driven asset prices to such dizzying heights. The macro leverage that had fueled the boom was now working in reverse. The withdrawal of liquidity triggered a severe contraction in valuation multiples across all asset classes. Long-duration assets, particularly high-growth technology stocks that relied heavily on low discount rates, suffered catastrophic drawdowns. The bond market, traditionally a safe haven during equity sell-offs, experienced its worst year in recorded history as yields spiked. Investors who had built portfolios optimized for a zero-interest rate environment found themselves entirely exposed to a new, hostile regime. The correlation between stocks and bonds turned positive, dismantling the protective benefits of the traditional balanced portfolio. Navigating this new landscape requires a fundamental shift in investment strategy. The era of passive index investing, where simply buying the broader market guaranteed outsized returns due to central bank support, has ended. Investors must now prioritize companies with robust balance sheets, strong free cash flow generation, and the pricing power necessary to defend profit margins against sticky inflation. Capital allocation must become highly selective, focusing on businesses that can organically fund their own growth rather than relying on continuous access to cheap debt markets. In a higher interest rate environment, financial leverage transitions from a powerful tailwind to a severe operational risk. Companies that relied on floating rate debt to finance aggressive expansion are seeing their interest expenses surge, eating directly into net income. The strategic use of debt must now be meticulously calculated, ensuring that the return on invested capital significantly exceeds the rising cost of borrowing. Deleveraging balance sheets and optimizing capital structures are no longer optional defensive maneuvers, but absolute imperatives for long-term corporate survival. For the individual investor, the scars of this monetary cycle remain deeply embedded in the economic fabric. While asset prices have experienced significant volatility, the absolute levels of wealth inequality forged during the quantitative easing era remain largely intact. The purchasing power of cash savings is finally generating a nominal yield, but often still lags behind the real rate of inflation. The modern investor faces the daunting task of preserving capital and generating real returns in an environment where the traditional rules of wealth accumulation have been fundamentally rewritten. A critical risk facing markets today is the assumption that central banks will immediately rush back to zero interest rates at the first sign of economic distress. The persistent threat of reigniting inflation severely limits the maneuverability of monetary policymakers. The threshold for central bank intervention is now significantly higher than it was during the previous decade. Market participants must price in the probability of a prolonged period of restrictive monetary policy, structurally elevating the cost of capital and demanding higher risk premiums for holding equities and corporate debt. This shifting paradigm is not isolated to a single domestic market. It represents a global macroeconomic realignment. Central banks around the world, from the European Central Bank to the Bank of England, have been forced to dismantle their own massive easing programs. The Bank of Japan, long the global anchor of zero interest rates, is facing immense pressure to normalize its monetary policy. As global liquidity drains from the system, capital flows are becoming increasingly volatile, seeking out jurisdictions with the most resilient economic fundamentals and the most credible monetary stewardship. To build resilient portfolios in this environment, investors must look beyond traditional equity and fixed income allocations. Real assets, infrastructure, and commodities often provide a crucial hedge against persistent inflation and currency debasement. Furthermore, active management, long dismissed during the era of easy money, is reclaiming its strategic importance. The ability to identify mispriced assets, exploit market inefficiencies, and tactically allocate capital across different sectors is essential when a rising macroeconomic tide is no longer guaranteed to lift all boats. The long-term consequences of expanding the money supply so aggressively will be debated by economists for generations. While these interventions successfully averted immediate economic collapse, they introduced severe structural distortions into the pricing of risk and the allocation of capital. The reliance on continuous monetary stimulus created zombie companies, suppressed natural economic cycles, and fueled speculative bubbles. Unwinding these distortions is a complex, multi-year process fraught with the potential for sudden market dislocations and profound economic pain. Understanding the mechanics of these monetary forces is the ultimate form of strategic leverage for the modern investor. It is the ability to look past daily market noise and recognize the underlying currents of liquidity and cost of capital that dictate broad asset class performance. By comprehending how quantitative easing artificially inflated valuations, one can logically anticipate the inevitable compression that occurs when that liquidity is withdrawn. This macroeconomic awareness allows investors to position themselves defensively ahead of structural shifts, rather than reacting emotionally to sudden market downturns. History demonstrates that market regimes rarely transition smoothly. The shift from an era of abundant liquidity to one of capital scarcity is characterized by heightened volatility, frequent bear market rallies, and a ruthless repricing of risk. The strategies that generated immense wealth over the last decade are precisely the strategies most vulnerable in the current environment. Adapting to this reality requires a rigorous reassessment of risk tolerance, a commitment to fundamental valuation metrics, and a deep respect for the destructive power of excessive financial leverage. The legacy of this grand monetary experiment is a permanently altered financial landscape. The wealth gap, widened by years of asset price inflation, continues to shape political discourse and social stability. The massive debt burdens accumulated by governments and corporations during the era of cheap money now represent a structural drag on future global growth. The market psychology, conditioned to expect central bank bailouts, is undergoing a painful, slow adjustment to a reality where risk actually carries severe consequences. Navigating this complex environment demands clarity, discipline, and an unwavering focus on probability over certainty. The modern investor must recognize that the tailwinds of infinite liquidity have dissipated. Wealth creation now relies on the meticulous identification of value, the prudent management of operational and financial leverage, and the strategic foresight to anticipate the long-term reverberations of macroeconomic policy. By understanding the profound impact of past monetary interventions, one can confidently construct a financial framework capable of withstanding the inevitable volatility of tomorrow's markets.